Hello everyone, and welcome back to another tax talk. Today, we're diving into a topic of Canadian-controlled private corporation, also called as CCPC. Let's first look into what a CCPC is. It's a private corporation that is incorporated in Canada and is a resident in Canada and controlled by Canadian owners or shareholders. If the corporation has been established as a CCPC, then it has many tax benefits, like lower tax rates. As we know, Canada has two separate tax rates. One tax goes to federal government, and another tax goes to provincial government. Provincial tax rate is different for each province. So if the corporation is resident of Ontario, its tax rate is 11.5%, and Quebec has different tax rate, and British Columbia has different tax rate. However, federal tax is fixed at 15%. And the corporation pays tax of 15% to federal government. Let's say, if the corporation earns $10,000, then it pays 15% to federal government, that is $1,500, and if it's a resident of Ontario, then additional 11.5% will be paid to Ontario. Now, let's go back to the benefits of a corporation being a CCPC. A CCPC pays tax at a lower rate to federal government, so instead of paying tax at 15%, it pays tax at 9%. This is called small business deduction, and it's available only to a CCPC. However, it can only take advantage of this lower tax rate on the first $500,000 of its active business income. So, if the business earns more than $500,000, then the tax rate goes back to 15% for income above $500,000. Another tax advantage for a CCPC is that the corporation can get scientific research and experimental development tax credit. That means you can either get a cashback on filing taxes or get a credit to lower your taxes if you spend money on research and development. It's basically a federal tax incentive program in Canada that encourages businesses of all sizes and across all industries to do research and development in Canada. Some examples of expenses that qualify as research and development expenses are developing a new or improved products, creating a new processes, or improving existing ones, experimenting with materials, formulations, or software when the outcome is uncertain. Let's go over an example. Let's say the corporation spends $500,000 on developing a new software platform, paying salaries and testing materials. Then it could get tax back of $175,000 in refundable tax credits. That is 35% of $500,000. That means, it can either reduce its taxes by $175,000 or get a cashback of $175,000. For more details on research and development projects, feel free to check out the CRA website at below link. Let's move to another tax benefit for a CCPC, lifetime capital gains exemption, also called LCGE. It's like a once-in-a-lifetime, tax-free money for every individual in Canada. Let's say, I sold some shares and made a profit of $1 million. Ideally, I would have to pay tax on that profit, but instead, I can choose to use my lifetime capital gains exemption and not pay any tax on it. However, there's a limit for it. It's only tax-free for up to $1,016,836 of capital gains for the year 2025. So if I make more than this amount, I have to pay tax on additional capital gain. I've made a separate video on lifetime capital gains exemption and capital gains. Feel free to check it out for more details. Now, how does lifetime capital gains exemption provides tax benefits to CCPC? Let's go over an example. Let's say I'm the owner or shareholder of the corporation, and my corporation has a CCPC status. That is, it's a private corporation that is incorporated in Canada and is a resident in Canada and controlled by a Canadian owner. Now I want to retire, so I plan to sell my business, that is the corporation. When I sell its shares, I make a profit, that's called capital gain. Let's say, I made a capital gain of $1 million. Now I'll have to pay tax on it, but instead, I will use my lifetime capital gains exemption and not pay any tax on this profit. Now, the corporation can lose its CCPC status anytime and lose these tax benefits. Let's go over the scenarios that can change its CCPC status. If a non-Canadian investor or public corporation buys more than 50% of the shares, the corporation loses its CCPC status, and the tax benefits are lost. For example, if my friend is a US resident and decides to invest in my corporation, if he buys more than 50% of shares, then the CCPC status of my corporation is gone, and I cannot use any of the tax benefits. Another scenario to lose CCPC status is, if I decide to list its shares on a stock exchange, then it loses its status, as it will become public corporation, and no longer be a private corporation. Sometimes, even an amalgamation, or a reorganization, can change the status of CCPC, if the resulting corporation does not meet CCPC criteria. I've made a separate video on amalgamation and reorganization, feel free to check it out for more details. Also, if the corporation is no longer a resident of Canada, it loses its CCPC status. Hence, it's very important to monitor the CCPC status, as even a temporary change in ownership can affect eligibility for the tax benefits. It is important to review shareholder structure regularly, especially before major events like bringing in foreign investors, reorganizations, or amalgamations, or planning an IPO, or even sale of the business. Hope you have a better understanding of what CCPC is and how it works. That's all for this video. If you have any questions, comments, or would like me to explain any other tax topic in detail, please feel free to drop a comment below. If you found this video helpful, please give it a like, hit that subscribe button, and share it with your friends who could really use some help. Good luck. Bye for now.